The global supply chain under strain like never before. A new IHS Markit report finds that disruptions will run well into this year, while addressing them will be less of a sprint and more of a marathon. Joining me right now is IHS Markit Vice Chairman and the author of the new map, Energy, Climate, and Clash of Nations. Author Dan Yergin is here. Daniel Yergin, great to see you. Thanks very much for being here.
Maria.
Tell me about this report, because I've been reporting on this program now for weeks that my sources are telling me that the chip shortage got worse at the end of last year. What can you tell us?
Well, I think it really runs across everything from chip shortages, which is why there aren't new cars and why there's a shortage of used cars, to those empty shelves in the store and all the cargo ships that are backed up off Los Angeles. So it's pervasive, and it's, as one part of it gets solved, another part gets there, because you have different kinds of chips that are going to be shortage. And this is, as you said, this is the worst disruption of the global supply chains that have been built up over the last 30 years that's ever happened, and it's not going to be solved soon.
Well, what are the implications in terms of looking at oil now at $91 a barrel? Dan, what's your take on what's behind this move in oil? And you wrote an entire book about the new map. What is that map?
Well, the new map, we're seeing it play out right now in terms of energy. The positive side of the new map is what's happening in the United States. The best news going on in world oil markets today is the recovery of U.S. production. But, Maria, it's a very tight oil market. It's just two countries have spare capacity. And it's the economic rebound. It is supply chain issues that affected the oil industry like everything else. And, of course, that crisis that is on the borders of Ukraine is feeding into the oil price, because two of the three biggest oil producers in the world are the United States and Russia.
Yeah, I know. And this report is finding that businesses will be forced to pay more for labor this year due to the high inflation, the high cost of energy as well, and that tight labor market. I've spoken in the last several weeks with J.P. Morgan CEO Jamie Dimon and Bank of America CEO Brian Moynihan. Listen to what they told me last month about how tight the labor market is right now. Watch.
Yeah, so here's the amazing thing. With all we talk about the supply chains at Omicron, we're having all this growth with supply chain problems in Omicron. And that's the way I would look at it, not the other way around. And I think it's just slowing down the growth and slowing down the recovery, but you still have a very powerful economy underneath. And yes, probably one of the first times in my life, there's huge pressure and wages and people.
Importantly, we have been on a task to make sure that we are the best place for employees to work. So our core employees have gotten high single-digit wage increases year after year after year. We're in our last year we did our fourth straight year of company-wide bonuses and company-wide stock. We continue to drive the ownership of our company towards our employees to give them a chance to participate in our success. So we believe this is broad-based. Now, when you go talk to our clients, wage growth and the inflationary aspects of wage growth and the pressure that puts on their margins is a very serious concern, and I think that's what the Fed has to start to work on.
Dan, what do you think is behind this tight labor force? I mean, is it truck drivers are leaving the job because of vaccine mandates? Is it the price of oil? Is it the shutdown over COVID? What's the real issue here?
Well, COVID has been a part of it, and then it's the Great Resignation, and the fact that the undersupplied in terms of labor, in terms of filling positions. So we see that. You would look at things you wouldn't think about, but the shelves in the supermarkets that are empty, it's partly because of lack of drivers and also lack of agricultural workers or people even in the food processing chains. And all of that, as you're pointing out, where does it all go? It goes to inflation, and certainly oil prices that are heading perhaps to $100 a barrel are going into inflation as well. Gasoline is getting close to $3.50 a gallon across the country.
Wow. Yeah, that's up 50% year over year. Let's talk Ukraine and Russia, Dan, because here we have these tensions rising. Everyone I've spoken with, they say we are expecting an invasion. Russia with 120,000 troops around the border of Ukraine, and they're thinking that will be the final, the final push to get oil all the way up there to $100 a barrel, as you say. What are your expectations?
Well, I certainly think if there's military action, prices will go up. There'll be a panic in the market. It's already, you can see that the financial markets are expecting it. And when there will be disruptions that will occur, the U.S. will put massive sanctions on Russia. That will disrupt supply chains. That will disrupt the flow of energy. So the day after, we'll wake up, Maria, and it will be a different world.
Will that cause a recession? Do you think that's going to impact economic growth with sky-high oil prices?
Yeah, I think so. Today, actually, we're lowering our estimate for world economic growth down to 4%. We had it at 4.3%, and it's these factors plus that central banks will start tightening, and that will put pressure on economies as well and slow down the growth. But you'll have a very different and a very tense world if Russia invades. And when you look at the forces that are arrayed there, how does Putin get out of this? He's put all those in the position, and the demands that he's put on the West are ones that the West can't meet.
So you said IHS lowering your global growth rate. What does that mean for the U.S.? Are you also taking expectations down for the U.S. on growth?
Yeah, we're taking U.S. expectations down, not as much as we're doing on the world, but we are taking them down today. Yes, and it has to do with what you've been talking about, inflation and the response to it. And of course, the supply disruptions continue to affect delays for manufacturers are the longest they've ever been recorded.
All right, we will leave it there. Daniel Yergin, always great to see you. Thank you, sir.
Good to see you.